Welcome, everyone. Very excited to have you join us for the second Super Meetup. Today, the topic is instant payments, and you'll hear from a power pack panel. And I don't want to age them, but I think we've got more than a century worth of payments experience up here. Let me first introduce Superset and the moderator for today. Superset is a startup studio where great data and AI ideas become transformational software companies. It was founded in 2019 by Tom, Vivek, and Jeremy, sitting right here. And over the last 4 years, we built about a dozen, founded and built about a dozen startups. And we just celebrated our first major exit last week with Habu being acquired by LiveRamp. Our moderator for today is Darwin. I've known Darwin since last August. And we met through mutual friends, and he's been guiding us through our journey in FinTech and payments and also finding good whiskey. So with this, I'll ask Darwin to take over and first share a surprising fact about himself.
Well, I didn't know I was going to be first with that one. So we mentioned whiskey, so that was something I picked up during the pandemic. Just a little love for whiskey and bourbon because we had nowhere else to go. But the other thing I picked up was smoking meats. So that's something that, so two things kind of go exactly. So that became my hobby, and that's why the black shirt is making a little more slimming. So I want to introduce our panel here. So first we have Seb. He was the Chief Technologist over at Zelle, best-selling author of The Delivery Man. Next to him is Gil, founder and CEO of Astra, all-in-one platform for moving money instantly and securely. And then we have Sumit, who is the former VP of product at Circle. He was instrumental in the internationalization strategy of stablecoins. And at the very end is Veena, former head of product over at Socure, really focusing on analytics, fraud, and identity. So I'm going to extend that first question to you. Let's share a quick fun fact about each of you that's not going to show up on LinkedIn.
Oh.
So Seb?
All right, so I do like whiskey too, and wine and beer. So as part of, by the way, if you buy my books, I'll give you the pairing list that goes with it. And I'm part French, Scots, Irish, therefore I do play the bagpipe.
Wow. Awesome, I guess it's my turn. I also smoke meats. Less on the bourbon train, but similarly interested in making all things yummy, pork and beef. Fun fact about me, I think if I wasn't here, I'd be designing and building technology for pinnacle athletes at companies like Nike. You can see some of my work kind of implicitly if you watch football, basketball, baseball on athletes' feet.
Nice.
Great. Well, keeping up with the theme of alcohol, I did become a mixologist during COVID. So that's something I really enjoy. Fun fact about me, I'm ambidextrous. So the sports team, I play all racket sports with my left hand, but then I'm actually right-handed when I play soccer. I've been playing soccer for like 20 plus years. And career-wise, I think if I was not an engineer or in business as I am, I think I would be a chef.
I have to move away from the alcohol trail. So I don't know if it's fun fact, but it's fun for me. I'm sort of self-teaching myself Mandarin lately for the last 3 months. I only know 10 words yet, so it's going slow, but it's actually fun. So
Awesome.
All right, we're going to start with a little timeline. So in 2010, first crypto payment, probably the most expensive crypto payment, like 10,000 Bitcoins for 2 pizzas, which equates to about $520 million in today's dollars. So hope that pizza was good.
Very good pizza, yeah.
2017, I think Zelle was introduced, real-time payments was introduced by the clearinghouse. 2018, first USDC, one of the stable coins that Coinbase and Circle launched in 2018. 2023, FedNow launched. So we have some adoption, like 482 or so on RTP, 400 plus on FedNow. All of a sudden, we've got a little traction now. So as a matter of fact, last year, Clearinghouse said they processed 47 billion in instant payments, but this only represents 1% of total payment volume in the US. So first question for our panel here. We've been talking about faster and cheaper payments for a number of years, and now it's finally feels like it's taking shape here in the US. So, but these products have been around for 14 years. So why now? So I'm going to start with you, Gil, because you're building these rails for real-time payments. So what were the headwinds preventing us from early adoption? What are the tailwinds that are helping us out right now?
Sure thing. Also, I don't know if I didn't catch it, but there's also Visa Direct and MasterCard Send,
Yeah.
filling the gap between RTP and FedNow.
Yeah.
In terms of like why we're here now, I think there's kind of two things that are critical to talk about, especially given the context that in the U.S. nothing is homogenous when it comes to payments, right? Like if we try and look at the corollaries, which I'm sure UPI and things are going to come up here shortly, they could kind of start from tabula rasa, whereas here we have a mature financial system. We have like two different systems for ACH, now two corresponding systems for real-time credits, RTP and FedNow. You've got Visa and MasterCard, like duopolies are at least what we're dealing with, much less the kind of complicated nature of having thousands of financial institutions that are interfacing with these rails. So one, why are we here today? There are enough different types of real-time payments to match different use cases so that they can start to be adopted in different scenarios, different industries accordingly, right? Not everyone's going to use FedNow, not everyone's going to use Visa Direct, and you keep filling in the different acronyms, right? But there's starting to become, I think, enough diversification where the settlement protocols that match the payment type can go along with industry use cases and enough range of scenarios that they can apply towards those applications. Part two is that now that we're moving into decade 2 of real-time payments, or about to, based on your timeline, consumers and businesses are comfortable, familiar, and kind of expect real-time payments. So if you've interfaced with Cash App or Venmo or Zelle or Uber driver payouts, that's like the baseline now. So now the bar of expectations from a usage perspective in one of those respective applications is higher. And so now more people kind of have to adopt whether or not they intended to or otherwise.
So do you have anything to add to that?
Sure, and besides being a former Zelle, I'm also a former MasterCard and PayPal, so I'm not very neutral on that one. But one of the things also that's happening right now, and you have to be aware of that, and I'm gonna put some global color on that. The EU has mandated a transition to a new standards for messaging formatting in payment, which is called ISO 20022. I won't bore you with the details, but as my life as a consultant, I've been spending a lot of time working around these standards and the transition from the older standard in the US to that new standard. Why is it important? It's because in the EU in 2024, you must do the transition to that standard, and on January 1st, 2025, that's it. You're done. So if you're a US company doing some transaction or business with the EU, or you're a bank in the US having a presence in the EU, you have to consider that now. It's not like, oh, I'll do it on January 1st, 2025. It will be done. So that also regulatory mandate, and the new type of formatting, the technology has evolved so much from the day we released Zelle. When I look at it, it's just like, whoa. The timing is now, and people are not realizing, but when we were like launching Zelle in the first 3 months, we're onboarding 100,000 users per day. So on a scale point of view, it was massive, but it was not a mandate. FedNow is not a mandate, right? But that standard coming from the EU and dripping down to the US is a mandate. And that's how you get this convergence of elements that means like, yes, it's the timing now. You have no choice. So I leave the words for this.
Yeah, I think it's interesting how the US operates versus Europe and other places in the world. To your point, Gil, things over here are ultra competitive. So there's always that arbitrage of being separate, fragmented. You can, run a business case on that, as opposed to Europe, where it's a lot more homogeneous. People over there are more connected in terms of where they work, where they live, where they operate, where they travel. It's all connected. There's a need to have a homogeneous system. There's a lot of cross-border movement of money and people. So that drives things more naturally to be more homogeneous as opposed to the US. So those things are changing here too, but not because of homogeneity, but this is just the consumer demand is in that way, right? There's a need to cut down the costs. There's a need to be more transparent and faster. So different set of factors, which is why the US has been a little slower. but it's getting to that point where, the adoption, the onboarding, I think will get to a much higher level, as you were saying. And the last thing I'll say on that is, you always need a catalyst to accelerate how things are moving. And in the US and otherwise, I come from the Web3 world for some last 3-4 years. And when you've got this fire burning called blockchain and crypto and so on, right, it does become a catalyst for the other legacy foundations to move, to change. And I think we're seeing some of that acceleration because of this new foundation being built, which you could consider as a threat to legacy, or it's a complement to the legacy. In my opinion, they'll coexist for quite some time, but I think those will all aid the consumer and businesses in the long term.
Yeah, so I think it's a great question on why now for Fed payments. So there are really 2 points I want to make. One is financial inclusion. There are a lot of payment methods, Zelle, Venmo, credit card, cash, checks. They don't die away. So among all these, a lot of the protection, when you make a payment, digital payments especially, which is kind of where most of us are in the current world. It's always protected at the merchant level, not at the consumer level. So there's a lot of challenges in that, and instant payment actually is offering that in terms of protection. And secondly, financial inclusion. It's not just limited to regular payments that you make to your merchants, or you pay, or it's a payroll that is actually kind of coming through. They're talking about I can order groceries and then use instant payments where the settlement is done between the merchant through the FedSafe, and then I can just wire the money from a bank and everything is settled in real time. So I think that use case is kind of very exciting, and they're going to go beyond just lending or financial instruments. And I think that's why instant payments is going to be quite interesting to see the growth in the next few years.
Veena, you mentioned security of transactions, and that's your background. So what is being put in place? Because right now, instant payments are exactly that. They're instant. So the moment it leaves your wallet, there's no recourse. There's no, you can't pull it back. So what is the industry's viewpoint on that? What's being done to make people feel more secure that once I send it out, that the transaction is not fraudulent?
Yeah. So one of the reasons why instant payments, I believe, kind of is interesting is full end-to-end encryption. Like I mentioned before, the encryption has always been burdened towards the merchant side. The data protection is on the merchant side. But from a consumer perspective, there was a lot of things that when NFC came, people were worried, if I carried my NFC card, can I just, walk through some things and, will it tap? Or, also any those type of digital payments where it came through. There was a lot of ambiguity and also lack of trust from a consumer perspective that was there. I think one of the things with instant payment, which I know that a lot of education is needed, not only by users, but also by people who are providing it, where I think you have to articulate the challenges and the protection it provides, in terms of firstly, no PII will be stored when instant payments are settled. It will be tokenized. It is a full end-to-end encryption. All these things also is, beneficial not only for the consumer. If nobody stores my SSN, my name, date of birth, everything for just making, receiving or sending a payment, I'm happy about that. Secondly, the merchants are also not burdened to save that data, protect that data, and worry about data breaches and maintain that. So I think that is going to be a big, factor in driving, one is, ease of use, but also the comfort and the security, both between, merchants and consumers.
So
I'm gonna real life example of the burden sometimes you have to carry. So when we're launching Zelle, again, these are not payment, real-time, instant payment, whatever. It's a risk management system at the end of the day. We had these little features where we're asking actually users to grant us access to their address book. Not that we were like noisy and fishy and we wanted to see what was going on in the address book. We don't care who you are talking to or who you are connected to. But when you enter that phone number to transfer the money, if you fat finger what number, we could push a notification letting you know like, hey, we see that number in your address book and you want to send money to that person. Did you really mean to do that? Yes or no, right? 95% of the user rejected that option, right? So we were left with, okay, what do we do now? Keeping in mind that, again, instant payment is going through the debit or the DDA rails, which does not offer the $49 protection of the credit card system, which is a federal law. So when you do that instant payment, the money is gone, that's it. So we were trying actually to provide an extra layer of protection for the consumer, and we try to explain it through ads. We try to explain it through like, the notification is trying to tell you that. But when 95% of the users do not understand why you're doing that, or you're spying on me, right? You're big brother, you're spying on me, or like it's like the swamp is looking at my information. We didn't care. We were just trying to add a layer of protection through we had a 12-step risk moment through a Zelle transaction. And that was like the 13-hour step, which was like, by the way, are you really sure? And everybody rejected it, that 13-hour moment. So we can provide a lot of security, but at the end of the day, if you don't explain or you can onboard the user properly or explain to them what's going on, it's kind of hard to explain the liability that goes with it.
Yeah, I think this is where it begs the question about that instant payment. Is it really something which is more beneficial, let's say, for the merchants because of fraud protection and really, adds to the bottom line? That's the driving motivation, is a fraud protection more so than offering convenience only to the customer. For the customer, it's like, I just want the convenience, make it fast, right? Are they thinking about fraud protection? Probably not as much. So you got different value propositions on both ends of the spectrum. So you're driving it from one side based on fraud protection, hitting the bottom line, and from the other side, you're pushing it from a convenience standpoint.
Yeah, but I think from a customer usage perspective, I definitely, they're not thinking fraud protection, right? But at the same time, they are also not willing. I mean, they probably will feel more comfortable if you only asked my name and email. I will be, happier to give it versus if you ask me my email, social security, date of birth, and my name.
What about your bank?
And your mother's maiden name and everything.
Yeah. So, and I think what instant payments is trying to do is kind of create like a token, encrypted token, which would be, validated and then stored in a token vault. And then every time I need to send money to somebody, I could use my unique payment identity and share that. At that point, once I know I've established with, a bank or, somewhere that I know is protecting my data fairly well, then I don't have to repeatedly give it to anybody. So let's say I give it to my bank. Everyone has to do it because we transact using a bank as a primary source of financial instrument. But I don't want to give it to every merchant I do. I don't want to give it to and today you download an app and they ask for your email and phone, and I'm always thinking, why are they asking? Because they can't protect all this data. So it makes me uncomfortable to give so much information about myself all the time. That's why I think having the payment token as part of this would be something that I think once consumer understand that we're there, it's just an identity, it is not actual PII, then I think they will be comfortable.
I think that's the biggest challenge is anyone knows how to explain to my parents what is a token? Because if you know, please let me know. That would be awesome.
I think coming from where I sit, which is like way down in the pipes, right? Like
Exactly. That's why you're here.
tokens and like a universal identity that I can interface with multiple applications sounds amazing. I'm dealing with more foundational problems, like way down lower in the stack. I think the one of the big challenges, maybe taking a step back, that I see with instant payments is there's a lot of conflation around use case and rail and what the trade-off is around risk, security, and convenience, right? Because if we're talking about directionally a push payment, I want to send funds on Zelle. I have the funds already. I don't have to give my bank credentials. I want to send it to someone else or to my other bank account. That is a hard problem, but it is not as hard as saying, okay, well, actually, I represent the merchant. and my merchant wants to be able to receive an instant payment. Well, actually, all instant payments effectively are push if we're talking about the fiat rails in the US. So there's no like pull that's actually instant on both settlement and authorization. So now you're saying, okay, consumer, enter in some registration number, your bank account, or your credentials through something like Plaid. Let me evaluate that so that I can request a push payment or start it as not a real-time payment and end it as a real-time payment. Now you're getting to the point where a consumer's like, I don't care about this. Why do I want to give my bank credentials? This is weird. I'm just trying to check out of Instacart. Oh, what do I have in my pocket? This piece of plastic that's super convenient. I know this number. I know I can go to my bank and claim it was unauthorized. Convenience becomes like way indexed on the other end of the spectrum for consumers where, like, why would they adopt a FedNow push payment? I think is like a question that we don't really ask ourselves, because pay by bank sounds sexy and it would change the economics and the risk profile for the merchant. But is the consumer really going to be interested in that?
And I think as part of FedNow, by the way, people have to realize FedNow is a B2B proposition. It's not a B2B2C proposition. So it's, as you mentioned, like you're building the plumbing, the rails. FedNow was put together actually to provide the B2B connection between bank, the account-to-account type of transaction, so that there would not be any more like batch push at 5 p.m. through the clearinghouse or whatever, the ACH network. So it could be instant. So I think that's something we also have to reframe, which is like FedNow is not a consumer-facing proposition. It's really a business-to-business. Does it got an impact on how consumers are going to be able to transact, on which rail they're going to land? They won't understand which rail they're going to land, but yes. And will it be an impact on how they are exposed to potential risk if the transaction goes wrong? Like, I wanted to send $2,000 to my aunt to buy this jewelry and she never received it. Real use case, by the way, from someone calling the call center at Zelle, which was fraud. You may have suspected, but anyway, that's something that's going to be important. I think like the next step is Zelle was clearly, like consumer or P2P like PayPal. Then we moved to that clearing system, B2B to C potentially, and people got a bit confused with RTP. And then FedNow came in, and people were still in the mind frame of like, oh, it's a B2B to C, and how are we going to present FedNow to the consumer? Step back, it's a B2B proposition. And I feel like we are resetting the clock on a lot of things on real-time payment here in the US, so that we can truly address what's been observed and seen in other countries or other continent, so we can do it right. And is FedNow the right thing, the right approach? I think so. Do they have the right tools or the right technology with ISO 20022 and the XML and JSON type? And I'm going very techy here, but can they go through API to facilitate integration through companies who do not, or business who do not understand technology? Yes. Is it an uphill, climb to get to the consumer? Yes. How are we going to do that? That's why we have a panel, and I will defer to the panel.
Well, Seb, you mentioned the international aspect of it, so let's pivot there a little bit. So it's been around, like I said, in the U.S. for 14 years, a little bit longer than that internationally. So why are other countries, other regions quicker to adopt this? In India, I think in Japan, I think real-time payments existed back in the 19-somethings. It wasn't 24/7 at that time, but that got moved to 24/7 in the 2010s, somewhere around there. But in India, what I'm told is that's the expectation. So why is it that U.S. is so slow to adopt?
I'm going back to Veena, but if you want to jump in, the consumer protection is built in by default. Right, in the US, using the debit rail, using the DDA account, you have zero protection as a consumer. Internationally, the first step was, if the transaction goes wrong, you as a consumer, you are not liable. Step number one. Then you go to build the rest. So I don't know if you have more detail, but that was like the big one.
Not only, outside US, right, when you look at countries, Europe, Australia, Malaysia, India, when they decided with payment instrument, government, kind of came up with the framework, and then they were able to push that within, like, across all their top issuers and banks and networks to kind of adopt it. They provided them incentives so that the banks would adopt it and offer it as services to their consumers. And that's how the adoption actually increased. In the US, it's a very infringed market. I mean, there is same day ACH, there's 3 to 5 day ACH, there's wires, there's, like Swift payments. And I think other than people who are techies in the financial space, nobody understands them, nobody knows they exist. All I know is if I need to pay my gardener, I use Zelle. If I need to pay my friend, I use Venmo. And those are just app-based payments. But basically, there's no standard that even, like you said, Federal Reserve took so long just to even come up with this, group. Even RTP, we never really, we started with an idea, but we never kind of got around it. The top banks participated, Visa, MasterCard participated. And even with FedNow, there's a lot of still like unknowns and confusion with like top networks, because Visa wants to do it certain way, MasterCard does it certain way. There's no like coherency. And I think that infringed disparate market within the US continues to exist, challenging the adoption and payment instruments, unlike in other countries where, they have mostly, mandated a lot of these through policies and protection.
I think that if I can jump in, I think the interesting thing that you said is that it's like mandated, but implicit there is that it can be coordinated, right? Every geography we just mentioned or rattled off, how many banks operate within that geography? Probably you can hold it in your hand, like 5 or less, right? So if you're talking about how real-time payments may evolve from RTP and FedNow today to what they can be, and we're talking about pay by bank and consumer interfacing with it, the thing that's going to unlock everything is the interoperability to the institution that is sending the payment, right? So like, yes, if you're in your Chase account and you're going to send an RTP, you don't really know you're doing that, but you can do that behind the scenes. Wonderful. But if I want to say, hey, Darwin, please send me $500. Now, for you to do that, there has to be interoperability from your side to say, okay, yes, I'm going to authorize and send this, which means that I have to ask you for the payment and you to authorize it and send it. So the request for payment part has not been solved here. I mean, Zelle, yes, and to some degree, the card networks to, if you like, asterisk, right?
So you're referring to the pull versus the push, right?
Right, the pull versus push. Mechanically, who is sending to whom and who is approving that or authorizing it at the sending financial institution? When you have less than 5 banks operating in a geography, the government can incentivize those 5 banks, and it's like, all right, it's Monday, we're going after Bank A. Tuesday, Bank B. We're going to get them all lined up, and they'll agree on what the standard is or adopt the standard that we've mandated. And now, like, we're getting coverage, like big swaths, right? In the US, there are thousands of financial institutions. How are you going to get them all to align on something? Yes, they all have to kind of fall in line between the top 5, behind the top 5. But still, like, that is a heterogeneous system that needs, like, something that's going to catalyze them to choose. And when we already have a kind of dual system between the clearinghouse and the Fed and RTP and FedNow and Visa and MasterCard, like, it just complicates it further. So, like, whether there's a man, go ahead.
I was going to say, like, and I'm going to like plug in Summit, so you can jump in. So in May 2018, I was in Brazil when they pushed through the first real-time payment crypto transaction. Right, so it was through Pix. There was, I don't know, like blockchain integration, and it was a commercial business-to-business transaction. That was not like a fake one, right? I was flawed because I'm coming from Silicon Valley. It's like, we should have done that like way before them. No, that was in Brazil and they did it, and that was like, wow. But granted, they only have like, I think like they have like 12 banks over there, 12 big banks and plus the smaller one. And they have the central banks, but they also have like regions. And some of the regions were in southern Brazil, they didn't care about what the central bank was asking. They had their own system, right? And then you go to northern Brazil, it's like the Amazonian forest, like where you have like all the hackers farm and everything. They definitely do not care about what the central bank is asking. But that transaction happened because one, there was a mandate from the central bank to do that. Yes, they got a couple of banks to play along the game, but everything that was done behind the scene, the build-up, was done by small companies, unrelated to the banks, unrelated to the financial systems. And they were not necessarily coming from Web3, but they understood the concept of decentralized finance. They understood, and they just pushed that through. And sitting there in that conference, I always remember like watching that demo and that transfer, just like, wow.
And
That
I think
just
this is
blew my
really one
mind.
of the things that gets lost is that yes, there's a lot of fragmentation. Again, I always say this: fragmentation leads to arbitrage, that leads to a lot of money in the bank. That's what typically the US operates on. Lots of fragmentation, as opposed to Latin America and so on. So governments, India, Brazil, they can mandate things. They can have faster. There are less incumbents in the process, right? So it's faster to do it. But the other thing is all of these places we talk about, Latin America, Asia, and so on, and Africa as well, we keep forgetting about that, is that honestly, the system that they had inherited from the colonials were like 100 years old, up until like the late 1990s and so on, is when they started to think digital. And 1990s, 2000s, they said, okay, you know what, digital transformation. So they didn't go through all this incremental 1, 2, 3 steps that we have done over here, which is why we're like, okay, we get this, we get Visa Direct, we get blah, 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 blah. They're like, you know what, we're going all in. The government can actually mandate it. There aren't too many incumbents. Customers are ready. There are younger populations who are actually really asking for better technology in the palm of their hand. And we will leapfrog all of these generations. And where are we going to go? We'll go to UPI. We'll go to PIX. We'll go to, blockchain or whatever. So it's a confluence of all of these factors. And like I said earlier, in many cases, it's just you need those forcing functions, whether it's a government, it's a technology. But if it's just purely behavior related, guess what? It's going to take forever. So I think in the US, things are slow because everything is so behavior centric, user experience. In some places, good or bad, it gets mandated. So it's, what do you prefer? Right?
Well, I guess optionality is a double-edged sword, right?
Yeah.
But you mentioned technology as one of the drivers, and I guess getting away from like having fragmented banking systems. Wasn't crypto and like stablecoin and things like that? Didn't that offer the same type of value prop in terms of faster payments, safer, less costly and things like that? So,
It does. I mean, blockchain, if you put crypto aside for just a moment, just the fundamental premise of blockchain is that speed, privacy, immutability, you're not controlling what everybody else wants to do, decentralization, all of those things are still relevant. But when you throw in a use case like finance on top of this transport mechanism called blockchain, and again, the financial instruments are the biggest users of blockchain, right? Even today, the financial use cases are the biggest on blockchain. There's supply chain, there's other things as well. But any time you get this money movement coming in, what are you going to bring in? Some negative elements. So crypto's been around for some time, but it's not been around for so long. But in this frenzy, unfortunately, what has happened is more negatives than positives, and what sticks in people's mind is the negative. And it has happened because of pure human interference at a negative level and lack of regulation. So I think that narrative is beginning to change a little bit again, but the promise remains. I mean, if you really leave alone all the things that happened to the FTX and all the others in the last year, but then you look outside, we talked about Latin America, you talk about Brazil, you go to Argentina where inflation is like over 100%, right? You go to places in Asia where they don't want to hold the local currency, they want the actual US dollar, Tether, USDC, whatever. Because when they wake up in the morning, they want to buy milk. It shouldn't cost you 2 times. I can still use my dollar. So I think the promise still exists. Remittances is booming quite a bit using digital wallets that can now hold digital currencies such as stablecoins, right? So I think all that will slowly but surely keep moving. The decentralized finance DeFi market is beginning to get some more signs of life. So there's movement in that direction, and I'm sure you're seeing that, with all the cryptography that's required. So I don't think these live in isolated areas. At some point, blockchain, everything will begin to seep into traditional finance, and it is. Chase, Bank of America, BNY Mellon, all the big banks, they are partnering with blockchain crypto companies, and they're actually building private blockchains themselves, permission blockchains, as they call them, where you can actually operate and centralize and move things on your own. So the promise is there. It's just the implementation is important, and taking away that fear, the technicality of, oh my God, I got to put money from my Bank of America into a MetaMask wallet and then move it on a blockchain and then send it to somebody. Getting into crypto, getting out of crypto is very difficult, right? Any layman over here would know that. It's very, very hard. So it's going to be a journey to get to the point where it's easier. But the fundamental promise of blockchain, it's the same thing.
I'm gonna say the bad words, interchange.
Mm-hmm.
Everyone's here. So there's
Fragmentation, right there.
also another issue in the US where blockchain actually is kind of overriding that stuff, and that's scary for the banks, scary for the financial institution. So interchange anything. You go to Europe, the interchange is 0.0 random, irrelevant, right? You go in the US, you're talking about 2%, right? The biggest challenge with real-time payment that I've seen and the pushback here in the US, which was insane, was, but we are going to lose the float.
True.
And you look, it's just like, but you can make money another way. Yeah, but it's gonna require some work. And the point is, we don't want to do the work, right? The bank has been the laziest institution for the past 800 years. Give me your money, we're gonna give it to someone else, we're gonna get the interest, we're gonna charge it, that's gonna be for us, and we're never gonna tell you we get interest on your money we loan to someone else. But anyway, that's how it works. That's the float, right?
It is.
And when you look at real time, it's just like, well, the money is not gone. How do I manage the float? That's gone, right? And that's something that also in the US, that's a problem, is we have not addressed the way the rewarding system works and how, the network, the banks are getting a outrageous level of rewards for doing transaction with your money.
Absolutely.
Right? Europe addressed it and said, like, that's it, we're done. You can't charge more than that. I always joke, like, I have a mortgage, okay, don't get me wrong, but here in the US, and I'm paying like 4%, I think, or 3.75, and I'm kicking and screaming, and I'm seeing it's like the rate is like 10% or more, which is like, okay, I have a mortgage in Europe where I had to fight to not pay more than 0.15%. And they gave it to me, right? So that gives you the idea of like what we are dealing here. And that's also a resistance we have to address from they want to find an incentive to do that move where they accept to lose some money, and you have to like deal with like that side of the back office and say, well, you can make money on the front office, you can make money, with the consumer side, but they are not willing to accept that. Example, and then I give back the floor to the panel. When they created Square created cash pay or whatever, cash app, sorry. They put these two options, which was like you can receive money in 3 or 4 days, or you can receive money right now.
Correct.
Right, but you have to pay a fee, and their expectation was you have to pay a fee, will never take off, and that was like kind of like a proposition is going to be pushed aside. Guess what? 70% of the people went and said like, I want the money now, I'm going to pay that fee. Look at that, I'm making money now. Oops. So
Not just a little bit of money.
not just, yeah, right.
$1.8 billion a year.
But talking about behavior, right? They anticipated that the behavior will be one way, and surprised that went the complete other way. So with real-time payment, with changing the infrastructure and everything, push the float aside, be creative, be like Cash App. Put an option there, and just, you never know what's going to happen.
So real quick question to follow up on that. Is that more of a consumer behavior or merchant behavior where people are willing to or is it dollar amount? I mean, what causes people to say, okay, yeah, I am willing to pay a fee to get it 3 days earlier?
The merchant love to pay that fee to get the money right away, and when they release that good, there is no turning back. The good's been released, they're not going to lose the money because they have a chargeback or whatever. But surprisingly, actually, it works also on the consumer side. Person to person, friend to friends.
Yeah.
Hey, I'm just paying the bill for the drinks tonight, and I'm going to send you that money. And by the way, if you pay like 0.15%, you get the money right away. Well, granted, you may have been drunk, but press.
I'm not going to remember. I'm not going to remember in the morning.
Actually, I'll take some of the blame. When we launched this at PayPal, I was at PayPal for a couple of years, and we launched instant transfers, it was called, on Visa and MasterCard rails. And I was surprised too, because I think it's just that people are just habituated to pay a fee to get a service and feel in power, right? So this, to your point about consumer versus merchant, consumer versus enterprise, I mean, the US is a consumer economy, right? The power is, supposedly with the consumer, but at the back end, it's all merchant driven. So when you have these options and you're habituated to get access quickly, I mean, there is some benefit for cash flow purposes for sure. But going back to the previous comments, that if this was completely taken out from the business model, and you had no choice but to make it at 0.015 bips or whatever, then yeah, it would be a different game.
He's fighting that one, but
And you won.
Oh,
he won, yeah.
I did sign the paperwork for 0.1. That's okay.
Yeah.
Gil, any thoughts on that?
Yeah, I mean, I think, consumers expect to pay a fee or are okay paying a fee. We talk about that at Astra in the context of time to money, right? Because not all payments are created equal. Not all payments should be fast. Not all payments should be slow. And so really what you're doing is trying to optimize time to money against another factor. Sometimes that's risk. Sometimes that's convenience. Sometimes that's cost, right? And so, when anyone can effectively have that kind of Cash App experience, it means that it should mean more interoperability for consumers to do what they want, more convenience, and generally to drive down some of the market rates so that it becomes more cost effective for the end consumer. Because some people prefer it, but some people need it, right? And like the fee, in contrast to a payday loan, maybe is like nominal, like not that big of a deal to them. But at the same time, like having the $500 in their account right now, in a world where most people are doing business as themselves more and more than they had before. So like, we think a lot about consumer finance and like, do I need my money right now? I'm probably well off enough, and most people in this room, where it's like, I don't really need it. I'll take the free version. Like, I'll take it in a couple days. Like, I'm okay to like let this business, like, I'll handle the float myself.
Yeah.
Right. But other people need it faster, and that's just a nature of their specific finances. But that usually is the thing that people are talking about. Like, oh, this is very expensive for consumers, or maybe it's like a convenience thing or whatever. But the same context applies when you're doing business as yourself, right? Like one of our fastest growing segments is trucking. And interestingly enough, like Uber, more people are owner operators today with an 18-wheeler than they were before. You used to just work for one fleet. They employed you. You got a W-2. They took care of the expenses. You're good to go. Now I own my rig or I lease it. I do a job for Fleet 1. I do another job for Fleet 2. In between, I need some funds from my current gig to get it in there, to put money in the, to put fuel in the truck, and do it all again and keep going. In that context, like, what are we talking about convenience and fees for, really? This is like making our economy move forward, and instant payments in those alternative use cases that we don't talk enough about, I think are really formative and will help drive things forward from like an adoption perspective that's not just narrowly defined on the consumer side.
No, consumer persona is so important. And that's a really, really good description. I think fees is not always for a bad reason, is the bottom line. But again, it's the notion of having a fee feels that way.
Yeah, I think consumers pay for the convenience. Like you said, if I wanted to get, $10 today and not wait for it, they would do it. But I think what is also stopping the adoption and the availability of this widely is a little bit of a traditional thinking of financial institutions. One is their rails don't support it today. So they have to build something, which means they have to invest in technology and kind of like figure out how to make it work and still make it available along with all the other things that they're offering in terms of financial institution services. And then second thing is, I think banks don't like the idea that if I send it to Sumit today, maybe it's a good transaction, but if I send it to Sumit and it didn't reach him, then they have to do recourse on like recovery, dispute, chargeback. So there's a lot of operational costs for them. And that's why they like to hold it for 3 days. They want to keep thinking, is this really Sumit? Has she sent it to Sumit? Is she willing to send it to Sumit? And then, they think that holding it by 3 days, that they feel like they are doing their due diligence. And they don't have to make, a decision with limited information at point of initiation. And I think that's another reason why banks don't like it, consumers love it. And there's a little bit of a, maybe what I would say, a difference in how usage and usability is.
It goes back to it's like risk management and liability, right? So people may not know that, but when you start doing a transaction with Zelle, you have actually 12 basic risk moments running in the background, including understanding your device, the operating system, the application, when it was installed, when the account was created. So there's a lot of things happening, basic things. One red flag, and you're entering into the secondary rails, right? That's what I call like ISO 2022. I always joke it's like like single messaging, and we are going from the world of dual messaging. If there is one red flag, you're going back to the old system, right? And suddenly your transaction is supposed to real time. That's supposed to be within your wallet within like 2 seconds, and you can go into the ATM, get your money. It's going to be like, well, maybe it's going to be 2 hours, or maybe it's going to be 2 days, right? Depending on that red flag that was triggered. So it's also like, I think the company will be successful in the US, and the banks are good at it, the networks are good at it. And that's where they should focus, is like the risk management side of the transaction, right? From point A to point B, can I almost instantly say that that's in network, that's an account that's been open for like 10 years, that's in network, that's an account that's been open for 6 years, therefore the risk is almost nil. Let it through, right? Even if you have a red flag.
Yeah.
Thank you for describing Astra, by the way.
I just want to make one comment, sorry. I mean, recently I was talking to somebody in a bank, and we're talking every payment that goes through. I mean, let's say I pay someone every month, and I still have to send the entire PII. They have everything because I'm doing the same payment month over month. I pay the same person. They don't need it every time they need it, that I make a payment. So that is something that banks have not really kind of changed, because if they have already verified, a payee and a beneficiary, then they should be able to accept it and kind of like reduce the,
Do it every single time.
yeah.
We were acknowledged banks are lazy, right? So
Yeah,
that's
so
probably
I think
reason
that's
number one.
why.
Don't quote me on that one, but yeah.
Quote, it's in his book. All right, I want to open at this time.
That's
I want to open up to some questions from the audience. I'm sure some of this may have like spurred on some thinking, some questions from you guys.
So I have the mic. If anyone wants to ask a question, I have a bunch of questions, but I always get accused of hogging the mic. So, if anyone has questions, just let me know. I'll pass the mic to you.
So hello. So it feels like on the consumer side, I'm going to go to fees for a moment. On the consumer side for credit card payments, I feel like we have been trained to understand them to be about 3%. You go to a store and like, well, if you want to pay with a card, it's going to be about 3%. I'm curious, this is sort of, I guess, to Gil, but I'm sure others. So I know you allow merchants or providers to sort of add on extra fees to what you're charging. Are you seeing people sort of settling into what consumers might expect to pay for this service? Is it volatile, or are folks figuring out sort of what to charge for this?
I think so. The short answer is yes. And I think that it's pretty easy to look at Cash App and Venmo and PayPal and be like, okay, this is kind of what people expect. And by and large, if you're electing to assess a fee on a per transaction basis for a deposit, let's say into an account that you own, maybe that is 1.5% for it to be there immediately, and that might cover your costs. Because from a blended average, depending on who your customer base is, maybe they're banking with Chase 75% of the time, and they're banking with long tail financial institutions 25% of the time. So now you've got Durbin unregulated interchange, and which is all very complicated and really hard to calculate, and neglecting to talk to business or commercial bins as well. But you can be in that range and actually enable a fast payment for a deposit on, let's say, the card rails, we're talking about merchant acquiring, and still be about break even or enough to help subsidize other aspects of your business. Now, on that deposit side, that's a hard proposition because most consumer applications are trying to encourage deposits. So you're saying, yes, I want to encourage you. Please deposit more money and use the most convenient factor, which is the plastic in your pocket. But then, so maybe you don't always assess a fee. But on the payout side, that's where the interchange dynamic is different. The costs are way lower, and they're capped, by the way. So you can charge market rate of 1.5, which I think is now up to 1.75 for Cash App and Venmo. And now you're generating a lot of margin, which can help supplement, to your point, other parts of your business. So you can, if you're the owner of the product, you can eat the fee if you want to, and just pay the interchange for the best user experience, the 12 out of 10 user experience on the inbound. And then for payouts, whether that's back to my other account or to a counterparty, you can assess the fee and have some healthy margin to apply to what you're going to be paying the networks and the underlying financial institutions for interchange.
I'm going to be very controversial, by the way. I always say, like, if you're an American and you want to know if you're a good driver, you go to Paris at 6 p.m. on the Arc de Triomphe, and if you can make it from one side to the other side, then you're a good driver. Now, for real-time payment, you go to Australia, right? And you walk into an Irish pub, and you're going to look at the cashiers, right? It's going to tell you, like, if you want to pay cash, there's an additional 2%. If you want to pay real-time, it costs you 0%.
Oh.
If you want to pay credit card, it's 10% more. Right? And as a consumer, I walked in and I'm just like, if you're tipsy after, like St. Patrick's Day, whatever, you go like, which decision I'm going to make, right? But I think like the US consumer also have not been exposed to the fact that there is a cost for the merchant. And it can be very hefty, right? So that's also a part of like bringing like real-time payment and understand, like educating like merchants. You can also like lower your cost as cash costs money to handle, and credit card costs an interchange rate to handle, right, to process. Real-time payment and debit type rails are much cheaper, but there is maybe more exposure, there may be more risk, but let the consumer sometimes see what you as a merchant you are facing, so they can also understand why you're making that decision or in the UK, like no cash accepted, right? There's a education part that goes with it. That Irish pub is in Sydney, Northern District. I don't know.
Let's go Sebastian special there.
Yeah, I've been there a few times.
A question over. Ayush, come across.
So we haven't touched on the cultural aspect of this, right? In the US, the culture in the consumers is, I love my credit. I love me getting the 30 to 45 days to pay for what I bought. The fact that if I had to pay cash for buying my house, 90% of us would be not living in a house. So, I love the credit. The merchant makes money selling me more than I can afford. The bank makes money by charging me interest rate if I can't pay back on time. So the whole cultural thing works. In India, for example, the number of cell phone connections outnumber the credit cards by 100 to 1. So they needed something else to make it work. So the cultural aspect of this is where I think, as you said, Seb, that when will we see the government actually allowing the merchant to say that if you pay by credit, it's going to be 10% more. But if you pay instantly, it's free. Because I think the regulations today do not allow merchants to charge a surcharge more than 2 or 3%. So I think the cultural aspect of this is what I'm curious about, is how do you think that affects the take-up of instant payments? Obviously, we love to receive money instantly, but we don't love to pay instantly.
That's called the Taylor Swift effect, right? Where you get like how much do you pay and how much you get back and everything. Anyway, but if you look like in Europe, for example, it did work in favor of the consumer, the merchant, and the payment industry, because they have what is called like deferred credit, right? So they build the instant payment on the deferred credit rails, which is like you're paying debit. Your money is out of your bank account as soon as you do that transaction, but it's reconciled at the end of the month. What does that give to a financial institution is risk management. Now, if you're doing like an instant payment, you have like whenever that happens, if it happened that instant payment happened like the second day of the month, you have 28 days to do your risk management, right? If you can't do risk management in 28 days, I'm sorry, but you should not be in business. If that happened on the 30th or 31st of the month or 29th this year, yes, you have a bit less time, but you should get good at it, because you have a lot of practice and a lot of runway to do that, right? As a consumer, I know at the end of the month I have to pay my old bills because it's a deferred credit. So if I don't have the money in my bank account, I'm gonna get whacked with an overdraft fee. I'm going to bet whack with something other fees, right? So the consumer understands the concept of like I have 30 days of deferred credit. The bank understands the concept that I have 30 days to do my risk management on the transaction that are actually eating that account. And then the regulators, the government understood that, hey, we can build some real-time payment on that, which is not really real-time. The transaction is real-time from point A to point B, but then the reconciliation from bank to bank behind the scene is going to be like a 30 days game. So yes, you can enforce regulation at a point of time because the banks are going to be like, yeah, I still have like 30 days. I still have my float that goes on, and that's how it works. The US is a different beast, right? Because you don't have like, again, FedNow is not a mandate. It's an option. You have like the interchange is much higher, the float is much higher. So, and the consumer does not understand that if you have your credit card, can anyone define what is an APR versus a real interest rate here? Well, if we know we may, but most consumers do not understand that concept. Like APR is not interest rate. It's not really what you're gonna pay at the end of the day. It looks pretty on paper, great, but it's gonna cost you your legs and your arm and maybe your firstborn. And that's the difference of the system. Again, it's like, as you say, it's like you say, it's very fragmented. We have to deal with like so many different options in the US. Europe or Asia or India is like it's just like much more like, I don't want to say like control, but the fragmentation is not as big, and the consumer I think is more aware, or the behavior goes with what is supposed to happen. Here in the US, like the Wild Wild West. So
yeah, it also aligns with what Sumit said, right? Because they went from not having much to like really adopting to the newer technology quicker. Then with US, you have to rip something to then replace it. Rip and replace is probably more tougher than having just building something brand
it's
new.
more
and just
painful.
love it.
It's more painful.
If it's somewhat working, you're not less incentivized to really fix it, right?
Well, maybe conversely, instead of thinking of it as we need to rip and replace a bunch of legacy rails that have trillions of dollars each running through them on an annual basis, like what if they just worked better together? Like one layer up. that
What
you
a
actually-
concept.
Yeah, well, yeah. I mean, but
See,
I mean,
It's
no,
so
seriously.
here's the analogy that
so
I that I would
socialist.
use. What?
It's very socialist. Yeah.
No, it's not. It's
well, I think the question is right. If
futurist.
something
Futurist.
totally innovative comes around, again, I don't know the numbers, but if there's some miracle solution, miracle startup that comes up and says, I can normalize all of this in the US, the chances are that they will get gobbled up at some valuation by a bank or some kind of a larger institution. So it's an operation where, yes, we are as small companies. I think you mentioned smaller companies doing quick things, but how much power do they really have to bend the system, right? When you have the large banks and the others, again, I'm not putting them down, but to flourish with new ideas, you need more time, you need longevity, you need stamina to ride it through. You need money and resources. And typically that does not happen because somebody's going to come, they're going to put you in an incubation within the company to see how that performs over the long term, and then blend you into the company. So I think there's a lot of factors. And just going back to your point about the cultural thing, even the other way is true. A lot of the not so good habits of the Western consumer mindset have seeped in now into Asia, big time. Everybody is buying on credit, they're living on credit, right? So culturally, money causes pollution, right? So regardless of where you are, there's always the ups and downs, but this is where, education, the user experience, all of those things at the top of the stack. Obviously, you build at the bottom of the stack, but there's things at the top of the stack too that matter.
Right, so our bad habits are now global.
Absolutely.
Okay.
And
so we're
there's
leaders on that. All right. So we start off with a little timeline. So one other little snippet here says FinTech Nexus is predicting that as early as 2026, real-time payments, which is only 2 years away, will make up 71% of payment transactions and 30% of payment volumes. Earlier, we started off with 1% in the current state. Quick thoughts on, is that how realistic is that? What needs to happen? Just
30%?
That's
Go
what it
from
says here from
30% in 2 years?
30% of payment volume.
Payment volume.
So in 2 years. A real.
The question I have is around the recurring payment
Oh, okay.
aspect, right? You pay your mortgage every month. If you wanted to pay it through Zelle or RTP, you would have to, in every single month, do a push of that payment. What would it take to get to making recurring payments help happen with instant payments? Because that's how you would get that adoption. If you could pay your utility bills, your bills that are regular that you have that you wouldn't put on a credit card. What would it take to get to that place?
First, banks have to build the technology to support it. That doesn't exist today. I think they themselves haven't figured out how consumers will use it. I think that, I've been talking to a few people. So they haven't really figured it out. They think it's a good idea, but they don't know what the adoption is. So that's one thing. The other thing is it's a little bit unknown right now from security, risk and fraud space. They don't know what the gaps are. One of the things that instant payments, when you think about how they, built that proposition, is they kind of looked at Zelle and they said, oh, these were the gaps that Zelle actually had not addressed when Zelle was actually established. So they tried to address that with instant payment, but it's not like a tested model in the market with large-scale usage. So there is that compliance and risk factors that's a little bit unknown, and that also makes banks, which are financially regulated, very nervous. So I think those are the two things that they need to address before it can get into widespread adoption.
And to answer your question, it's at the end of the day, it's you have to replace bill pay, right? And bill pay has been established, it's working, and the banks actually understand what's coming and they can anticipate. And again, going back to floats, can anticipate and we understand what's going on. Australia has built actually a system where you can use instant payment, especially if you're a renter and you want to pay your landlord at midnight or 11:59 p.m. on the day before, and the money goes out, and here you go, the money isn't. But actually the landlord cannot complain because the money has been registered as on the day off, right?
That's a great example of instant payment, because most landlords, a lot of small landlords, small property owners, you can't set up bill pay with them.
Yeah.
And instant payments are perfect for that.
Yeah, and that's the price, the repetition of it, and that's.
You can't set it up recurring.
Yeah, to do pool payments, I also, I don't really know the answer, but others can chime in. One of the things that I think about if I wanted to set up recurring payments, most gyms now are expecting you to give them your debit card number, not your credit card, unlike before. So gym is probably okay because it's a relatively smaller amount. They're not cheap anymore, but mortgage is a really large amount. I don't know if I will always have, $5,000 in my checking account for them to do a pool payment. And if there is a timing issue or or I have not moved the money, then it is actually very concerning for a lot of consumers. So there may be a lot of hesitation for adoption too, with larger payments.
Early wage access right now, that's the big conversation in FinTech. A lot of people want to pay their bills when they want to, so they can schedule them at a time, so they can sometimes have money come out of their paycheck so that they can actually plan to pay that bill at a different time than when it's actually when they're paid.
Yeah, the whole ecosystem, there are there are pockets that need to be addressed, and I don't think we're there yet.
Yeah, I think what you're talking about, like a lot of the gig economy, people want to be paid right away for their gig, right when they finish that shift, because they're going to turn it right around. I think Gil mentioned paying for gas or paying for your rent, and those 2 or 3 days between what typical payment right now, I have to pay 3 days early if it's due on the first of the month. Maybe I haven't worked that shift yet, or I have to wait till the next Friday before payroll. So I think those are very valid use cases. But
There's new companies now that are basically, they take the money out of your paycheck when you get paid and they hold it into an account and then pay your bill at the time that it's due, so that you never actually receive that money in front.
There's a lot of permutations on that. It's a really interesting space to follow. I think one of the things that we don't talk about enough is, even accelerated by COVID, is the exchange of value is real time if you give someone $20. That's a real time payment.
Yeah.
That's an exchange
The
of value
original
right now.
RTP.
I have it. And tips predominantly for people that work in the hospitality industry were cash based. or the restaurant or the hotel that you worked at had enough cash where you're like, hey, they signed the paper that said I can have my tips. I want it. Cash is not as frequently used, and maybe even by the restaurant mandated it's not going to be available. Things are moving.
That's an interesting use case because they have to pay, the restaurant has to absorb the credit card fee. So when you tip on a credit card, by law, they're not allowed to take that fee out. So real-time payments would be actually awesome for some restaurants are moving in that direction because of that.
True, but I think most merchants, whether it's a restaurant or a clothing store, they build in that fee for having merchant acquiring, right? Like, yeah, my hot dog was $5, but they are expecting to pay the 3% for that. They build that into the underlying cost. Right, but
Yeah.
right, but if I'm a bartender or I work at a hotel and cash-based tipping is not as prevalent anymore, I just worked a 6-hour shift. I want my tips. Like, why shouldn't I have my tips? My benchmark is I used to take $100 of cash home. Now what do I do? Because if it is the 30th and the first is on a Sunday, like I'm not going to wait till the next business day to get my funds. If I have access to taking it now, I'm going to.
And by the way, I'm going to give you an example that was awesome. In Paris, just landed. I have zero currency, no euros on me, because that does happen sometime. I have US dollars. And the doorbell just carried my suitcase up to my room. Right? It's like, okay. I'm just like, I'm sorry, I can't really tip you. I only have like $20. I'm just like, I'm a cheap bastard. So I'm like, $20. And the guy's just like, well, here's my phone. What do you want to use? Like Paylib, PayPal? He had like all this stuff, right? I'm just like, okay, you got me here. So
On top of the game.
Sorry, I'm but
It's QR codes.
In the hospitality industry, for example,
Yeah.
it's a great use case because that restaurant doesn't have that money in real time and they have to pay you out in full real time. And oh, by the way, when the law changed about chargebacks, when it used to be like if the chip wasn't presented or whatever, now the business has to absorb that cost. And in the beginning, there were a lot of American Express certain cards had a lot of chargebacks. So the instant payments, if they could be facilitated in those kind of businesses are very valuable. That's why a lot of nail salons and places like that have gone to tips exclusively through like Venmo. Or Cash App.
But that was like pretty awesome. I mean, like I had to tip him, of course. Can't get out of it. But that did not go through the hotel system. That was directly to him, and he got his money.
Yeah, I mean, the use cases are there.
Exactly. That was like that money never existed. That transfer never existed.
Exactly.
So, and I still have my $20 in my wallet. But anyway, long story short, that was very smart.
All right. Yusha, are we doing on time? Two more? All right.
Good stuff. So, as a consumer in the US, I'm highly, like what you said in Australia, I'm highly incentivized to use my card. I'm going to get 2% cash back, sometimes 5% cash back. So, how is that going to change? Why would I even do that if I'm going to be getting 2% cash back on every transaction on a card that gets accepted everywhere? Why would I change?
This is where the incentives for the companies goes down because they're not making enough money now, so they can't give you back enough. So I think a lot of these business models
I'm
would
gonna
be
give,
questioned.
actually, I just saw an example today from a friend, Maya Bittner, who was checking out, and she put it on Twitter. She lives on Twitter, which is like pretty crazy and weird. But anyway, but she was saying, I'm just checking out, and my options were in the checkout flow. Is all I have my options. But if I use instant payment, I'm gonna get 5% back on next time I'm gonna fill the gas tank of my car.
Okay, so that's a merchant incentive.
Yeah, but that was a very teeny fine print at the bottoms, right? So you have like all these options, but if you use that fine print, you get 5% back next time you go to the gas pump. And I was like, okay, now the merchant is like kind of gaming the system, right? Saying like if you use, yeah, but I mean like, exactly. But now it's just like if you use that one, I'm gonna give you more than what you were expecting in your usual reward card.
I'm going to give you more rewards later,
Yeah.
but not now.
Yeah, exactly. But that was, and by the way, that was using a branded card, right? A white label card. So the merchant control that card. They know how much they pay for credit. They know how much they pay for everything. But if you just transfer that, not using the white label card, but using that direct rails and go there, then I'll give you 5% of the top of your usual reward, right? And she did pick it up because she just like 5% of free gas. But
But I mean, I'm that's a consumer industry. Like, okay, if I pick that up, I'll probably see that. But
yeah.
right now, I can get 2% cash back on merchant one. And then I don't know.
Yeah, you just have to give an incentive that's bigger or more visible. It's all about discovery, right? So how do you get that discovery, and how do you move the? We were at PayPal. Is how do you move that payment instrument up to the front of the wallet?
But is that coming back to the question that at the end of the day, it's still going to cost you 2-3% because now you're going to incentivize it.
Well, I mean, I think that.
Yeah, but you're going back to that gas pump next month.
Yeah, sorry. I was just going to say that I think everyone needs to figure out where their sweet spots are. Merchants need to feel like they're making money off something, if not because all the reward points. I mean, airlines give a lot of like million miles. And then, how many people use it? How do you use it? I mean, how do they make money off it? You're using your card because they want all your spending to be top of your wallet. Otherwise, people may put it across 3 cards, which on an average, everyone owns, So you're incentivized to use that card. Merchants make money off that, you're spending. And so it's a sort of a cycle chain. I think one of the things I think all of us kind of are commenting is we don't know. And to the lady who kind of talked earlier, and Gil who said, I want to make the $6 whatever tips at the end of the day, there's an emotional component that I think we don't understand, which influences consumer behavior. Because if I am an hourly paid worker or I make tips and I feel gratified, like the concierge at the hotel, that I carry somebody's bag and I get tipped, and that's kind of like how their business works. Maybe nail salons are okay because they're like, we would rather get tips through Venmo, but probably concierges want to make sure that they see the cash, or bartenders want to see cash at the end of the day because maybe they feel like with other instruments, it's not as obvious to them that they're being appreciated. I mean, that's just my thought.
One final question. So it's 2024, and how can we have a discussion without mentioning generative AI? So somebody explained the benefit of instant payments as, of course, the speed and all of the low cost, but the data. When you have instant payments, confirmation, now you can automate a lot of your, as a CFO, processes and workflows. And then once you have data, you have AI and generative AI. In your minds and in your thoughts, how are you thinking about generative AI as either a challenge or benefiting from instant payments, and especially going back to our first question of why now, if instant payments is picking up, what role does generative AI play?
Who wants to start on that one?
I can comment a little bit. I think financial institutions have always had rich data. They've never, have dearth of PII. So that's why they're able to use analytics very innovatively. So Gen AI, machine learning, LLM, NLP, all these buzzwords kind of are derived from financial institution data, which is accurate, which is rich, which is structured, unlike other industries. So I don't think they have an issue. They have an issue right now with all these newer, where Apple said, oh, we're going to encrypt and not let people capture browsing history or IP data. So they are actually more worried about these type of regulations limiting. They also don't like the idea of encrypted data because they want to be able to go back and link to the individual for identity verification and authentication and fraud prevention, etc. So I don't think they have limit of it. I think they are going to continue lobbying to get more data and protect the data that they have. And that's really, where financial institutions think of Gen AI and so on. I don't think they are kind of like worried about it. They're more worried about losing it versus, kind of going there.
I'll do a controversial opinion. I don't think we're in an era where we need to be tackling payments from an inference problem perspective. I don't think payments are like the value is in the exchange. It's not in the inference of value based on some prior data. Now, I'll asterisk this in that a lot of recent conversation I think is really interesting around one of my friends, Io, who was one of the founding members of Cash App. He talks about time and money, but has been talking about time and money, but more recently, metadata on top of payments. If you talk about the metadata that should go with a payment to make it have more rich information that can then be inferred from, maybe we're talking about generative AI. But I think that there's still key fundamental issues where the exchange of value needs functional layers on top of it. And my analogy is data packets move across the internet by a series of hops from one place to another. We don't know anything about that. We type in a URL and Instacart or Google or Zelle show up on our webpage, right? There are still layers of abstraction and functionality that need to be built to provide that interoperability across the disparate networks and corresponding deterministic rules that go with each one of the payment systems, ACH, RTP, FedNow, AFTs, OCTs, MasterCard Send, et cetera, et cetera, et cetera, right? So like, I think that should we solve that, which is what, like truthfully and biased, that's our mission at Astra. Any point A to any point B, any payment instrument, any counterparty, as fast as possible, risk mitigation built in. If you do that, and then you can start to apply data on top of the actual payment, then it becomes really interesting with what AI might suggest or different opportunities might be presented there. But there are still like, we're at square 2 out of 10 before we get to the point where AI can be really powerful with payments, in my opinion.
I was going to just do a follow-up comment to say, I don't think they're using AI to solve the value problem. I think they're using AI to enhance marketing and kind of like do an upsell. So it's mostly like ancillary services versus actually trying to build a value.
I think you got to be careful about just saying AI and Gen AI in the same sentence. They're different things, right? Anybody here who's been in FinTech in this room knows that we've been using, or in financial services, even before FinTech came around, you've been using AI forever. Risk models and so on. And if you take the user journey from, awareness to onboarding to transactions to settlement, all of that, there's AI embedded along the way at every point. Gen AI, as you said, is being used more heavily, let's say, in customer segmentation, right? Massive area in product marketing, in behavioral analysis, and then subsequently tailoring the offers to the right audience at the right time for the right reasons. So I think Gen AI is obviously a subset of the AI that's being used within the financial services space. And just to go back to my background in Web3 and blockchain, this is the part that really, really excites me, because the amount of data being generated right now through blockchain in itself is no longer megabytes, gigabytes, it's not even petabytes, it's more than that. Now, if you take all of that and you can mine it for better risk models, better identity and authentication models and so on, you're driving a lot of value from AI married with blockchain data. And at some point, maybe Gen AI comes along as well. But I think the Gen AI use cases on top of all of these things would be more, let's get at the end of the spectrum, where it's more forward thinking towards the consumer and experience at this time, versus tinkering with what's below that.
I'm going to say something very controversial, even more. I'm calling it like degenerative AI. Right? That's where we have to go. To your point, and I'm going to be very techy, so it's kind of late, you can leave if you don't care about tech and everything, but going back to the standard, ISO 20022, right? The messaging metadata embedded into that message is very different from the old system, right? That's where you can actually get information and figure it out how to use AI for risk management. Mm-hmm. But going beyond that is also detecting if there is an anomaly. Real time is about real time. And human cannot review all these transactions when you have like million of transactions. Can generative AI come in and play around like this is actually an hallucination? This is an anomaly, mm-hmm. right? That's degenerative AI for me. It's AI against AI. Can you embed something into that messaging system that goes through, and AI will, or generating AI will look at it and say like, pass the sniff test, it's kosher, that's good, go through, or wait a minute. I remember I was trained on the model and I hallucinated on that exact same thing like 2 years ago or 1 year ago. This is potential fraud. Let me pull that message out of the system and send it to a human for review, right? So that will actually optimize real time as only like few transactions will be put on hold. And at Zelle, we had that, which was like red flag, 2 hours instead of 2 seconds. Another red flag, 2 days instead of 2 hours, right? That's where it can play if you can embed that properly to just pull the thing that really need human reviews as that doesn't sound right.
You're moving the distribution of the percentage of payments that can be actually real time
Yeah.
against the risk by way
Yeah.
of the AI moving the
Exactly,
base of
like-
the curve
yeah.
further to the left.
Yeah. So I call that degenerative AI. It's AI against AI. Anyway.
I think that signals the end of the Gen AI hype and this session.
Do we want to answer the question about the 2026 prediction, or
Oh,
we,
go ahead.
so real quickly? I mean, how real is that, Seb?
Of what?
30%, 30% of payment volume by 2026.
Oh, easy.
Easily? You
Yeah,
think
easy, yeah.
We're gonna get there?
Oh, yeah.
No way, Jose.
No way.
No. Too
But
many
you're-
disparate systems, not enough adoption. And mostly because, like, especially when the financial institutions have to decide to play in that industry and with the corresponding real-time payments. Right now, if you are a mid-sized bank and you have not adopted RTP because you're not part of the clearinghouse, and you've not adopted FedNow because you're worried about which one should I choose. I have to do some implementation. I am not a tech-enabled institution. I have to choose. Which one's it going to be? I'm going to wait for something to tip towards one, and then I'll decide, put my resources behind that.
VHS
Wait,
versus
wait.
beta?
Do I have to take back my answer? Is like, what is your definition then of instant payment? Because in general, yes. In that detail, yeah, it's debatable.
well.
But yeah, in general, yes.
No, 30% no way. I mean, if you think about what's going on with even just real-time payments today, it's, I think almost like 70, 80% of that volume is being run or is going through smaller banks, credit unions. The larger banks still haven't been driving a lot of volume. So to get that number to 30% in 2 years, I think it's far out.
Well, one of the BOA, Bank of America statement by the guy was actually instant payment and Zelle replaced 30% of their check processing within the first 6 months.
Yeah, but it's check processing.
Yeah, but it depends. Again, like instant payment replacing what?
Yeah.
That's the definition. So existing stuff like checks and everything, absolutely. If you're talking about like, digital payment,
Yeah, I'm in agreement with Gil and Sumit here. I don't believe we will achieve that. I think we don't have the technology, firstly. And Gil also mentioned we're going to test, everyone will test the market. They don't want to be the first mover in this market. So I don't really see that happening in the next 2 years.
I think every bank is 5% off. Yeah. Maybe.
Yeah, talk to them one at a time. There's 4,000 plus FDIC insured banks. All right. I think that's all time we have for questions here.
Yeah, thank you so much. Can we have a round of applause for the speaker here?